world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Seth Rosenberg. Seth focuses on Fintech at Greylock, one of Silicon Valley's most storied venture firms, with noteworthy investments including LinkedIn, Facebook, Airbnb, and many more. In this conversation, we talk through Greylock's Fintech thesis, Seth's view of where the industry is going, and the way the firm looks at investments in general. We reference a great deck on Fintech that Greylock recently published, which we'll link to in the show notes. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Seth Rosenberg. Seth Rosenberg, welcome to Rebank.
Hey, thanks for having me.
Great to connect. I think it was through our mutual friends at Blend, a portfolio company of yours, that we ended up connecting today. Great company, and look forward to seeing them do interesting things. But you guys are pretty active in the fintech space, and thought it might be fun to connect and have a broader conversation around what you're thinking about.
Yeah, I'm looking forward to it.
Maybe for context, quick intro to you. I think you have some relevant operational experience prior to jumping over to the investment side.
Sure. My first job after college was actually at Goldman Sachs in New York. I was in the TMT investment banking group. Shortly after that, I actually snuck my way into a breakfast that I was not invited to that was hosted by Sam Lessin, who's a VC and operator in Silicon Valley. And he was trying to recruit, smart, hungry people that he could train to be product managers. And, when I heard about this, I got really excited about it. So I kind of, as an investment banking analyst, taught myself how to code and prepared for Facebook product management interviews. And 6 months later, ended up getting hired as a PM for Facebook. Joined in 2013, was one of the early PMs for Facebook Messenger. So was responsible for helping to separate Facebook Messenger into its own app. So it was kind of one of the most hated people in the world in the summer of 2014. And went from that to helping to build out the business and developer platform for Messenger. So everything from games and payments to interacting with businesses on Messenger and all the automation tools involved with that. I actually left to try my hand at building something on the other side of the platform as an entrepreneur. So worked on a health tech startup, and then an opening came up at Greylock to join the consumer investment team. So I joined about 2 years ago. I've been focused on everything consumer software, and lately I've been getting really excited about the opportunities in fintech.
Excellent. You published a deck recently, which I thought would be fun to kind of talk through and expand on a little bit. The place to start has to be the dozen-word sentence that you guys put together as to what fintech is or why it's important. What you came up with is infrastructure to exchange resources with unknown people and businesses. And you did a nice job in the deck of talking about exactly why each one of those words matters. Just very quick intro to your thought process and the way the team worked to come up with that thesis.
When I was presenting this to the partnership, my opening line was, I'm excited to explain how fintech works to an early employee founding team member of PayPal, to Reid Hoffman. So it was a little intimidating, helping to aggregate our thoughts and put together a structure of how we want to invest at Greylock in fintech. But that definition was actually really grounding for us. I wanted to go back to more first principles, which is, what is financial services? Why does it even exist in our society and our economy? And what purpose does it serve for people? Once you answer that question, then you ask the question, why is there a software opportunity to do those things better for people? And that's when you start to come up with really interesting pockets of opportunity. That sentence is really a reflection of understanding why financial services exists. Like the classic story of going back to, simpler times. If you have like a family farm and you're self-sustaining, you don't really need finance or money. But once you start introducing specialization in trade, you need a medium of exchange. You need a way to interact with strangers that you don't know and don't necessarily trust. And that's when financial services start to, become necessary. And so it evolves into, how do you interact and transact with people, with businesses that you don't know across time and across places. And that's where you see the modern financial industry, which is worth over $7 trillion in market cap in the US alone. And so if you distill all of those functions into one sentence, that's what we came up with. Infrastructure to exchange resources with unknown people and businesses. And you can think of products and services that fall into each one of those words and how each one is being transformed with software.
So I know what my answer to the question I'm about to ask you would be, but I'm interested in yours, which is, if you take that first principles approach to designing financial services and you start today, do you redesign the system as it currently looks with the institutions and counterparties that currently exist, or does it look completely different?
Obviously, in an ideal world, it looks different. There are structural and business reasons for why all of these siloed products exist. But at the end of the day, people are humans and have certain needs and want problems solved. And an ideal financial services industry, I think, would take up a lot smaller percentage of the economy with a lot less friction and a lot less fees, and just be kind of invisible and empowering and accelerator for the rest of the economy. So I think the ideal future is that rather than siloed financial products with high fees, you have background solutions that empower people and accelerate the economy.
I think it's particularly interesting, your background in consumer products and your specific mandate here around consumer investments, because it very much feels like with new infrastructure layers being built, banking, FS delivered in many cases, increasingly through APIs and surfaced in places where traditionally it hasn't been, that consumer angle, not a consumer finance angle, but consumer internet angle, is actually an important skill set to have for thinking about the way that product development might work, the way that value chain might look, and the way that product distribution could increasingly evolve. Facebook Messenger, right? It's like, in many ways, the optimal distribution channel for so many financial services products. What are your thoughts about how consumer tech and fintech potentially merge?
Yeah, that's a great question. I think the best consumer product people have a deep understanding of human psychology. And that was a common theme at Facebook, which was, there were posters on the wall that said, "Are we a technology company?" Challenging the question of, is this a tech company or is this like a human communication company? Is this a place where we understand the psychology of human connections and try to facilitate those interactions? And I think similarly, having a deep understanding of, the anxiety and the fear and the hope that interacting with money and finance can elicit in people is really important when you're building financial services products. I think it's one of the reasons why the last great budgeting app we can name is like Mint, because that's just an anxiety-inducing product. People don't necessarily want to spend time thinking through, did I spend too much money on my coffee this morning? They don't necessarily want to see that data. Whereas a lot of the services that have taken off recently try to eliminate anxiety and eliminate decision-making and just say, hey, I've got this. You can trust me, or you can trust this service.
When you look around and think about the consumer fintech propositions that are starting to emerge, those that are consolidating market position and some very new concepts, what companies, what products do you see as most interesting with that product hat on, consumer product hat on?
One way we think about it is, we meet hundreds of fintech companies throughout the year, and everyone has the strategy of, we're going to start with this product and then we're going to expand and provide all financial services for the individual. And what we try to unpack as investors is, do we believe that? And what's the probability that that will be true? And there's a few different frameworks that we've come up with. First is looking at the trade-off between frequency of interaction and depth of interaction with the consumer. So for example, on one end of the spectrum, you have robo-advisors. They have a very deep relationship with consumers, but it's not that frequent. So for example, you'll use a robo-advisor, you'll give them all of your retirement savings. So it's a very deep relationship, but I check it maybe once a year during tax time. And so their ability to add on services and products is limited because of their share of my attention. Then you have products on the other end of the spectrum that are very frequent, but fairly light. One example might be Venmo, right? I use Venmo maybe 2-3 times a week to pay my friends, but I'm not taking out a mortgage through Venmo. I'm not doing my direct deposits through Venmo. It's a fairly light but frequent experience. I think the ones that are better positioned to win potentially are things like challenger banks, where you actually have your direct deposit, you have a checkings account, you use it every day through the app or through the debit card. And it seems like they're occupying kind of a sweet spot there. A couple other considerations beyond that are what's the demographic of the user base, right? Are you going after the unbanked, lower income, higher income, and what opportunities and challenges does that come with? The third thing I think is your core product unlock any type of secret advantage for you? So for example, we invested in a company called PayJoy that is using software to power emerging market lending. And their initial product is point-of-sale loan to buy a smartphone. Their kind of secret advantage that unlocks is they have now better underwriting data on you than anyone else because their primary customers don't have credit history, and all of a sudden they've built up this database on you.
So in those emerging markets where they're operating, Experian, Call Credit, TransUnion don't exist. There are no centralized credit bureaus, so they become the de facto source, is what you're saying.
Exactly. I mean, that would be the best case scenario, and I think they're well positioned to go after that opportunity. But even on a less ambitious level, on a per customer LTV basis, they're going to be able to lend more money to that individual customer than anyone else because they have that data. Now, over time, I agree they do have that opportunity to be the kind of de facto credit bureau and data play for emerging markets, and I think that's really exciting.
Returning to the deck, you talked about the consolidation of a number of industries in the hands of a few companies. So, stories that I think most familiar with: music, entertainment, travel. Why, in your view, did that happen in other industries but not in financial services, or why hasn't it happened yet?
Yeah, well, that's one of the reasons I'm so excited about investing in fintech. Netflix market cap is sometimes larger right now. I think almost as large as Comcast, NBC, Comcast, Universal. In most cases, if you look at in the media space and you view Facebook as a media company, it's a $500 billion media company. It's bigger than all of the incumbents. So in most other verticals, like you said, transportation, travel, the kind of challenger tech company is already the most dominant. In financial services, that hasn't happened yet. And I fundamentally believe it will. And you have got $7 trillion of market cap to go after. And so that's why I'm so excited about the opportunity. The reason why it hasn't happened yet, I think there's a few reasons. I would bucket it into trust, regulation, and the power of incumbents. Starting with trust, there's the standard kind of joke in Silicon Valley of 10 years ago, you weren't supposed to meet people on the internet and you could never get in cars with strangers. And now you order a stranger from the internet to get in their car. And I think that's just a anecdote of how drastically things have changed. And I think in terms of consumer sentiment, a lot of digitally native people actually trust an algorithm or an app that's well designed more than some financial advisor in a suit. And that's a relatively new phenomenon. In terms of regulation, there's now regulations that actually give advantages to banks that have under $10 billion of assets under management in terms of interchange fees and the ability to get around some of the stress test regulations. And the power of incumbents, especially for wealthy Americans, they were actually pretty well served. And there's pretty broad coverage of financial services in the US. And so fintech companies had to start by kind of nipping away at the ankles of products that weren't provided or for people that weren't being served. So fintech companies had to start smaller, but just by nature of technology companies compounding in value with data, over time, they're going to start going after the core.
What is, to use your words, an outlier company?
At Greylock, that's really what we're focused on finding and investing in and backing and helping to build. Our history over, I think, 53, 54 years has been consistently being involved in those outlier companies, whether it was leading the Series A of LinkedIn or Airbnb or Facebook for the Series B. What's super exciting about my job and our job is just trying to identify what those outlier companies are going to be. I think you're in fintech space right now, you're seeing players like Robinhood and Stripe and Square break out as outliers. And part of this deck that I put together was a framework of how we're going to find the next one.
Do you have a certain set of characteristics or a framework that you use to think about defining an outlier company and helping you find them?
Yeah, so there were two things. One was company-specific characteristics, and then two was just categories of where we think they're going to exist. So in terms of categories, I laid out 5, which I think when we look at the next outlier company, it's going to probably fall into one of those categories. One is just infrastructure to power financial services, and you can get into all of those trends, but the kind of old world example of that would just be some of the payment rails or Visa or something like that. 2 is owning the full stack customer relationship. And again, the old world example of that is a retail bank, something like Wells Fargo. 3rd is using data to make proprietary decisions. PayJoy falls in that category to some extent, where they have the opportunity to build up the data set for lending in emerging markets. An existing company would be FICO in the public markets. The 4th is, marketplaces with liquidity to exchange resources. In our portfolio, a good example of that is Coinbase. The reason why it can be an outlier is because once you have that liquidity and that marketplace dynamic, it's hard to unseat you, and it can be a winner-take-most market. And then the 5th one is kind of the creation of new asset classes. And that's where I would put a lot of crypto and digital currencies.
And characteristics of specific companies? Is it just standard stuff, management team, execution strategy, product vision, that sort of stuff? Or are there more specific characteristics?
One of the privileges of our job is we get to meet with amazing companies, amazing entrepreneurs, and do some pattern matching. And through that process of seeing what's working, what's not, as well as just being a student of some of the best businesses, these outliers that have already broken out, we try to understand what are the characteristics of those companies so that we can make decisions earlier than others. And a few things we've kind of codified are, first and foremost, having a distribution advantage. Looking at any company that is just purely doing paid acquisition over Facebook and kind of doing the CAC LTV game tends to not lead to outstanding results. 2 is software as a core competitive advantage. We meet with a lot of companies that are more financial engineering based, and you can build good companies, or in some cases you can make money from those businesses, but they don't tend to be kind of the standard bearer outlier software companies. 3rd is lately we've been more attracted to companies that kind of operate more at the infrastructure layer, because we do see this huge wave of like all software companies becoming fintech companies, and backing infrastructure layers to power that is powerful, and it also comes with a built-in distribution advantage. And then the last one is reasonable capital intensity. And this is a very interesting and kind of hot topic, especially in today's markets, where you have very capital-intensive businesses that appear to be successful that kind of go against, I would say, the normal frameworks for investing.
Like WeWork or something.
Yeah, or Opendoor is a good example, where traditionally software VCs are not looking to deploy a bunch of equity capital in buying houses in America. But they have a strategy that is super interesting, which is how do you create a full stack service that's tech enabled and then potentially own both sides of the marketplace. And so that's an example of using capital as a weapon to then get to a place where you have kind of a marketplace dynamic. But what's dangerous is if you back a company that looks like Opendoor in terms of capital intensity, but doesn't have the same strategy of really getting out of that cycle of being a very capital intensive business. These are all part of the decisions that we make every day.
That's interesting. I'm going to go slightly off topic here for a second. The poster child early example of that was Uber, right? They're like, can we subsidize rides, get in the market, become the thing, roll out to new markets, and basically beat everyone else, build this massive moat around what we're doing. It costs too much for anyone else to challenge us. And they recently went public. Share price has been all over the place. Is the feeling that there's still a question mark around that strategy, or is the feeling that the investment community looks at that and says, okay, that's actually a viable approach, and this is something that we can back more companies in doing?
It's a good question. I think it's very nuanced. I think the danger is backing a capital intensive business that does not have marketplace dynamics, right? Or winner take most. You can justify the strategy if there's a path to winning, and winning takes you out of that game. I think the debate around Uber, even Uber, is are they ever gonna get out of that game of using capital to subsidize rides and acquire drivers, and like, do they really have local monopolies? And I think that's still TBD. But if that does play out, then that strategy will be validated. Within fintech, obviously, if you just look at the multiples of companies that are primarily balance sheet lenders versus companies that are more software platforms like Square or PayPal, it's drastically different. And so what we need to evaluate is what we call reasonable capital intensity. If you look at the sources of capital, the quality of capital, the amount of equity capital required to grow, and whether that is their fundamental business of just kind of arbitraging capital, or whether that's just a tool to build a broader software-based business.
That kind of suggests that investing in licensed banks, which are by nature capital intensive, wouldn't be on the immediate radar screen of Greylock.
It's not something that we are afraid of. We have a $1 billion fund and are able to, when the strategy makes sense, able to back companies that require capital, but we would have to be really sure and excited about the strategy of using that to get to a place that is less capital intensive.
I believe you, like many, have looked at and thought about the Asian model in many cases of the kind of full stack, full service financial app, or maybe it's a consumer app became a full service financial app. And I understand you're of the view, at least my belief is that you're of the view that that's not a model that can work in the West. Why is that?
Yeah, so what's really cool is when I was a product manager for Facebook Messenger, in 2014, we did a trip to Asia to see what was going on. And actually being there and seeing how dominant something like WeChat is in China is just absolutely phenomenal. So we went to Singapore, South Korea, and then China and visited WeChat's HQ. And I remember this scenario where I was talking to one of the PMs at WeChat, and he was saying, yeah, we just launched a high yield savings account like 3 months ago, where people can just put their excess money that they have on WeChat for payments into an account that earns them like 6% interest. And he's said, guess how much AUM we have. And they literally launched it like 2 or 3 months ago. I said, I don't know, like $5 billion.
Wealthfront got $1 billion in 1 month with their high yield savings account.
Okay, so that's a good benchmark. So this is a couple more months, and so I guessed $5 billion. The answer was $100 billion. So, I don't even want to know what that number is today. They're just operating in different environments, right? Like it's an amazing phenomenon where they just have the classic like technology leapfrog effect, where many people who are using WeChat every day are opening a bank account for the first time, and it's convenient through WeChat, to get those services, whether it's savings or payments. And so they don't have the switching costs of unseating incumbents. Their economy is structured differently with more centralized power. And so some of these companies are just able to consolidate services more effectively. That being said, I'm optimistic to see what's going to happen with Libra. I am very optimistic that there's going to be a reconsolidation of fintech companies. So I think you're going to see definitely more consolidation in the West, which is part of where the opportunity lies. But you're definitely not going to see an integrated consumer internet and consumer financial services company. I think those are likely going to be different with some gray areas.
You mentioned Libra. I'm glad you did. I was going to move in that direction eventually. So this is perfect, right? Because you're investors in Coinbase and you're personally former Facebook. So what are your views on Libra? Let me ask a more specific question. To me, it sounds like a really, if you set aside privacy concerns, sounds like a really compelling concept and kind of a very quick leap forward in terms of what the scope of fintech is, what it can do, how impactful it can be. And it could be massive to the point of kind of disrupting existing payments, disrupting in many cases existing banking, turning e-commerce into genuinely a kind of an integrated marketing plus data plus merchant, acquiring payments piece. Do you share my views or do you look at it differently at all?
Being on the ground floor of something that had a ton of promise and understanding how difficult it is to execute, which is the Messenger developer platform. In 2016, there was so much excitement and enthusiasm around, this is going to replace websites and replace apps, and Messenger bots and AI and automation is just going to be the future of mobile commerce. And I think, over time, there's some truth to that in the sense of, identifying the opportunity. But when you're on the ground of like changing consumer behavior, having businesses adopt a new technology, the fact that the technology is still early, I'm optimistic, but I would say more realistic in terms of, how quickly it's actually going to change everything. That being said, I love how practical and consumer oriented the product is. In David Marcus's opening line for Libra, he was saying, if you go on the streets of San Francisco or New York, the tech and finance hubs of the US and in some cases the world, and you ask a random person, how do you send $10 to Canada?
Get in the car.
Yeah, exactly. Most people just have no idea. Venmo doesn't work, just for anyone who's curious. I actually happen to be Canadian, so I do know how to do it, but it's not straightforward and it's not without fees. So just solving that one problem, which is, an international medium of exchange that doesn't have outrageous fees or foreign exchange conversions with the built-in distribution of Messenger and WhatsApp, I think is really exciting.
What do you make of someone like Coinbase being a founding partner, founding member, whatever they call them, of the platform?
It's amazing just how, the world ends up playing out in ways that are kind of predictable and fascinating. Blockchain as a technology for trustless systems. And then you have this giant, powerful communication platform of Facebook who has a trust problem. And so they're trying to launch a global currency. And I think they were really thoughtful in structuring the foundation in a way that's distributed, that doesn't give Facebook particularly special rights. And I think it's a pretty interesting application of the concept of trustless systems.
Do you believe that privacy first, trust Facebook, this is an arm's length thing, don't worry about your data being tracked and monitored? Do you believe that as a former Facebook employee? Is that something that you think is genuine? Would you confidently use this for your own personal finances?
I definitely would. And I think, unfortunately, what people don't understand is how bad the security and privacy is of existing solutions. It's an extremely low bar to beat. If you think about credit card payments and social security numbers, literally the state of the art for many payments is I say my credit card number out loud on the phone while my Uber driver is listening, or I write it down on a piece of paper. Or in the case of remittance payments, I pay like a 20-30% fee, and I don't have any particular ownership or privacy over the metadata of that transaction. So what's nice is I think that they have an incentive to innovate, and the only way to win and replace an existing system is to make it better. So yeah, I think they have the right incentives and capabilities to improve on the existing system.
What companies that you guys have invested in or haven't are you watching most closely in the fintech space?
I mentioned PayJoy, which I'm really excited about. We've done an early stage lending company that hasn't been announced yet that I'm really excited about.
What's the angle?
That one's more like kind of infrastructure layer around these same themes of all software companies are providing financial services, and payments being one of the APIs, led by Stripe, lending being another one. And that's what this company is going after. Ribbon Homes, really excited about, part of our portfolio, helping with the home buying process. And that one's a great example of like fitting all of our criteria in terms of, having a more efficient distribution model than some of the iBuyers, being less capital intensive, being more of a software and technology company. So I'm really excited about Ribbon Homes just going after the massive market that's broken in terms of real estate transactions. In terms of things outside of our portfolio, I'm really excited about this concept of like more liquid human capital. I'd say this is at risk of being slightly stereotypical in like the VC world. Companies like Lambda School, I think, are doing really innovative things. I almost think about it like an open door for humans, where you have algorithms to price.
You buy them.
You invest in them.
Okay.
You have algorithms to price and identify humans' future market potential. And then, Open Door refurbishes the houses. Lambda trains people. And then Open Door sells the houses and Lambda places them in jobs. Definitely the largest and most important, let's say in quotation mark, asset classes is people. Right. And in order to unlock kind of satisfaction and prosperity and fulfillment, I think we still have a huge amount of work to do. And I think technology and finance together can play an interesting role.
Seth Rosenberg, thank you very much for joining us today.
Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.